Want to keep more of your paycheck in 2025? The tax code has a few modern tricks that young Americans often miss, and if you use them correctly, this filing season you could boost your refund or lower your tax bill materially. Stay with me for 12 minutes, and I'll give you concrete legal tax hacks you can use tonight. I'll cover the highest impact moves for young earners, retirement tax wins, credits you may qualify for, smart ways to lower taxable income, simple filing choices that matter, and a practical 30-day checklist to lock in the savings before you file. If you're a recent grad, early career professional, or freelancer, your income is rising, but you may be missing deductions and credits that cost you thousands. That's not because you're careless, it's because the tax code updates every year and the best opportunities hide in plain sight. Quick orientation. Some central numbers you should know for 2025: standard deduction levels, retirement contribution limits, and tax bracket thresholds changed with inflation adjustments. These numbers determine whether you should itemize, max a retirement account, or capture credits. I'll show sources so you can check your inputs. Hack number 1. Pretend retirement is a tax refund machine. Contribute to a tax-advantaged retirement account before filing. For most young earners, that means using your employer 401k or an IRA. The 401k employee deferral limit for 2025 increased, and IRA contribution room remains valuable. Both reduce taxable income today and multiply through compounding. If your employer offers a match, contribute at least to get the full match. That's an instant 100% ROI on contributions. Practical steps for hack number 1. Increase your 401k deferral by 1% today. Small change, big impact. If you don't have a 401k, open a traditional IRA and contribute pre-filing up to the limit. That reduces your AGI and can increase phase-out eligibility for other credits. If your employer offers Roth versus pre-tax options, the pre-tax deferral lowers this year's tax bill while Roth grows tax-free for retirement. Hack number 2. Don't forget the saver's credit. If you're lower or moderate income and contribute to a retirement account, you may qualify for the saver's credit in 2025. It's a dollar-for-dollar non-refundable credit that directly reduces your tax bill, not just your taxable income. This helps early career savers more than you'd expect, so check your AGI against the credit thresholds before filing. Who benefits most from the saver's credit? Young professionals with MAGI in the low ranges who contribute to an IRA or employer plan. The credit phases out at higher incomes, so the secret is simple. If you qualify, prioritize a retirement contribution before year end or before filing, because it both builds your nest egg and qualifies you for the credit. Hack number 3. Use HSA, Health Savings Account, if you qualify. HSAs are triple tax advantage. Contributions are pre-tax or deductible, your money grows tax-free, and qualified medical withdrawals are tax-free. For 2025, HSA contribution limits are inflation adjusted. If you're eligible through a high deductible health plan, maxing or topping up your HSA before filing is one of the most tax efficient moves available. Plus, the HSA doubles as an emergency medical fund. Hack number 4. Tax loss harvesting for side income investors. If you have a small taxable brokerage account from Side Hustle Cash, you can harvest small capital losses to offset gains or up to $3,000 of ordinary income per year. Even small portfolio moves timed before tax filing can reduce your tax bill. Just avoid wash sale traps if you repurchase the same asset within 30 days. Hack number 5. Student loan interest and education credits. If you paid student loan interest in 2025, you may deduct up to $20,500 of student loan interest, subject to MAGI phase-outs. Additionally, education credits like the American Opportunity Credit for recent grads still in eligible courses can directly reduce taxes. Check eligibility rules carefully. They phase out with income. Hack number 6. Maximize above-the-line deductions. These are deductions you claim even if you don't itemize. Traditional IRA contributions, HSA contributions, student loan interest, and self-employment deductions like half of SE tax and retirement plan contributions. For young Americans who usually take the standard deduction, above-the-line items are the fast lane to lowering AGI. Hack number 7. Use the standard deduction wisely. The 2025 standard deduction rose, inflation adjustments. For many young filers, standard deduction still wins, but don't assume automatically. If you've paid significant student loan interest, charitable gifts of stock, or large medical bills, rare at young ages, run the numbers. Sometimes bunching year-to-year itemized deductions into one calendar year makes itemizing worthwhile. Hack number 8. freelancers, and gig workers. Don't forget the home office and business deductions. If you earn freelance or gig income, keep receipts for business expenses, use a dedicated bank account, and consider the home office deduction if you meet the requirements. Above all, track mileage and equipment purchases. Legitimate business expenses reduce self-employment tax and income tax. Practical freelancer move: set up quarterly estimated tax payments to avoid penalties, and open a solo 401k or ESPA IRA if you have consistent gig income. These increase retirement deductions while lowering taxable income. Contribution limits for retirement plans rose for 2025, so leverage them to both cut tax and invest. Hack number 9. Roth conversion strategically. If you expect higher income later, consider a small Roth conversion in a year your income is unusually low, e.g., job transition year. Converting a small amount from traditional IRA to Roth increases taxable income now but can reduce lifetime taxes if you expect to be in a higher bracket later. Do the math or consult a tax pro. Hack number 10. The bunching trick for charitable giving. If you occasionally give to charity, bunch 2 years of donations into one tax year to exceed the standard deduction threshold and itemize that year while taking the standard deduction the next. Using donor-advised funds helps time the tax deduction while smoothing actual grant timing. Rule of thumb: prioritize moves that reduce your adjusted gross income (AGI). Not only do they lower tax now, they often expand eligibility for credits and deductions that phase out with MAGI. Retirement contributions, HSA deposits, and student loan interest deductions are classic AGI reducers for young filers. Pitfall to avoid: number 1. Over-optimistic Roth contributions. Don't accidentally contribute to a Roth IRA when your MAGI exceeds the phase-out. You'll face penalties or need recharacterization steps. Check the income ranges before you fund and use a backdoor Roth strategy only if you understand the tax reporting. Pitfall to avoid: number 2. Ignoring employer benefits, tax-advantaged employer perks, commuter benefits, FSA, HSA payroll deductions, transit benefits, and flexible spending accounts. Reduce taxable income if used. If your employer offers them and you don't enroll, you're leaving free tax savings on the table. Live example: the Young Professional Playbook. Imagine you earned $65,000 in 2025, maxed employer match but didn't increase deferrals. If you bump 5% of salary to a pre-tax 401k, roughly $3,250, and contribute $3,500 to an HSA, your taxable income falls substantially. You'll likely move into lower effective tax burden and may qualify for savers credit if income thresholds line up. That's tangible money in your pocket. State tax tips: don't forget state returns. Many states conform to federal rules, but some diverge on credits, standard deductions, and student loan forgiveness treatment. If you moved states or worked remotely in multiple states in 2025, track income by state and file correctly to avoid surprise tax bills. Hack number 11. Tax-efficient employer stock and RSUs. If you receive RSUs, tax planning matters. Young employees often hold vested shares and then get taxed on fair market value at vesting. Consider selling a portion at vesting to cover tax withholding and avoid a liquidity trap. And consult a planner for timing if you can diversify gradually to reduce concentration risk. Hack number 12. Use automation for taxes. Set aside a percentage of side income automatically into a separate savings account for quarterly estimated taxes. For employees, use paycheck withholding tools or a W-4 adjustment if you consistently get large refunds or owe each year. Aim to pay neither too much nor too little upfront. Audit avoidance basics: keep good records, receipts, 1099s, bank statements, and avoid rounding or creative deductions without documentation. Young filers who keep clean digital files and backup receipts with a simple app reduce stress and speed any resolution. The IRS selects many audits by mismatch. Accurate records are your best defense. Bonus hack: check refundable credits you might miss. Depending on income and circumstances, you may qualify for refundable credits like the Earned Income Tax Credit (EITC) or portions of the Child Tax Credit. Refundable credits produce refunds even if your tax liability is zero. Check eligibility thresholds carefully. Mistakes that kill refunds: not reporting side hustle 1099 income, overclaiming business expenses without documentation, or missing credits due to AGI being just above thresholds. The simple cure: run 2 tax scenarios, one with pro-tax moves, retirement plus HSA, and one without, and pick the path that increases net after tax and long-term savings. If you made a mistake on prior returns, file an amended return, Form 1040-X, to claim missed credits or correct deductions. You generally have 3 years from the original filing date to amend and claim refunds. Don't assume a missed credit is gone forever. Fix it with an amendment. Night before filing checklist. Gather W-2s and 1099s, student loan interest statements, HSA, IRA, contribution records, receipts for deductible business expenses, and proof of dependence. Run a quick simulation in tax software to see the refund or liability, then implement last-minute tax moves like IRA HSA top-ups if they help. Common questions I hear: should I itemize or take the standard deduction? For most young Americans, the standard deduction still wins, but if you've had a big year for medical expenses, mortgage interest, or charitable gifts, run the math and consider bunching strategies for future years. When to call a pro: complicated situations, multi-state income, high freelance income, significant investments, RSUs, or crypto transactions often justify paying for a tax pro. A good CPA can often save you more than the fee by capturing credits and advising on year-end moves. Actionable 30-day sprint to maximize your 2025 filing. Day 1. Increase retirement deferral by 1 to 5%. Day 3. Fund or top up HSA if eligible. Day 7. Gather receipts and 1099s. Day 10. Simulate returns with and without above-the-line contributions. Day 20. Finalize contributions and set autopay for any tax due. Day 30. File or submit to a pro. A practical money mindset. Tax planning isn't about tricking the IRS, it's about legally timing income and deductions to keep more of what you earn and to seed long-term wealth. Treat taxes as part of your financial plan, not a separate headache. Resources I recommend: IRS pages for contribution and deduction limits, a reliable tax software simulator for your scenario, and a low-cost consultation with a CPA if you have self-employment or stock compensation. Links are in the description for the IRS retirement and savers credit pages and for a simple planning spreadsheet. Mini summary: top moves for young Americans in 2025: increase pre-tax retirement contributions, use HSA if eligible, claim the savers credit if you qualify, harvest small investment losses strategically, and automate savings for estimated taxes. Together, these moves can meaningfully increase your refund or lower tax owed. Next week, I'll break down Roth versus traditional, which is actually better for you in 2025. We'll run numbers across income levels and show exactly when a Roth makes sense, even for young earners. Subscribe so you don't miss that. If this helped, hit like and subscribe, share with a friend who's filing taxes for the first time, and comment with one tax move you'll try this year. I'll reply with a quick checklist tailored to your situation. Final encouragement: small legal tax moves compound. $3,000 in pre-tax contributions this year could be worth far more later than a one-time refund. Start with one step tonight: bump your 401k or open an IRA and let time and compounding work for you. Closing reminder: I'm not your CPA. Tax rules change and details matter. If you have a complex situation, consult a licensed tax professional. Links to official IRS guidance and helpful calculators are in the description. Go take one action now and lock in savings for 2025.